Welcome to the deep dive. Today, we're going to really dig into some specific financial intelligence. We're focusing just on the Q3 2025 AbbVie earnings call, and specifically, only the opening remarks from the CFO, Scott Runs.
Exactly. We're kind of cutting through the usual corporate talk, the marketing spin. We want you to understand three core things today. How did they actually perform financially in Q3? Why did they update their 2025 outlook? And maybe most importantly, what's the big capital strategy driving things forward?
Right. So for you listening, think of this as the financial blueprint from those remarks. Let's jump straight into Q3 then. What was that immediate headline number, the one that beat expectations right away?
Yeah, the quick win was definitely on the bottom line, adjusted earnings per share, EPS. It came in at $1.86. And that was, a solid 10 cents better than their own guidance midpoint. Shows good control, definitely.
10 cents above midpoint? Okay, a good start. But what about the top line? How did revenues look, and what part of the business did the heavy lifting?
Total net revenues were pretty close to $15.88 billion. That's showing operational growth of about 8.4%. And the real story, the CFO specifically called out their ex-UMR growth platform.
Ex-UMR, that's Skyrizi and Rinvoq, right? They're big immunology drugs.
That's them. And that platform reported sales growth over 20%, really beat what people were expecting.
Okay, so strong operational growth, ex-UMR leading the charge. But this is where it gets a little complex, I think, because if you just looked at the standard GAAP number, the net income, it took a big hit. We need to talk about this IPR&D thing in process R&D. A $1.50 negative impact on EPS, that sounds huge. Is that bad management?
Or just the cost of business now in pharma. Well, that's exactly the key point, isn't it? And it's why looking at the adjusted or non-GAAP numbers is so vital in this sector. That $1.50 hit, it wasn't really a loss in the operational sense. It was a massive investment in their future pipeline. It mostly came from upfront payments for two big moves, acquiring Capstone Therapeutics and also a license deal with IGI. So it's like they're using today's strong performance to immediately buy potential future blockbusters, funding that long-term security.
Got it. So trading current GAAP profit for future potential, essentially. If that's the strategy, how do we know the core business is still healthy underneath? Did the CFO give any operational ratios to show that efficiency is still there?
Yeah, he did. To kind of show the underlying strength before those big deal costs, he mentioned an adjusted gross margin of 83.9% of sales, which is, very high.
83.9%.
Wow. Right. And the adjusted operating margin ratio was 30.9% of sales. And importantly, even that 30.9% still included a 17% negative impact from those IPR&D charges we just talked about.
Sure.
So yeah, the core business is extremely profitable. It can absorb these big upfront investment costs and still maintain really strong margins.
Okay, that makes sense. It really sets the scene for how they view the rest of the year then. Let's pivot from Q3 performance to the outlook. They raised their full-year guidance again, right? Third time this year.
Third time, yeah. Shows confidence.
So what does that new confidence look like in terms of the EPS forecast?
The new range for full-year adjusted EPS is tighter now, between $10.61 and $10.65. But, and this is important, the CFO was very clear. This guidance doesn't include any guesses about potential acquired IPR&D costs that might happen after Q3.
Okay.
Oh.
So they're basically saying, here's our operational forecast, but future big deals aren't baked into this specific number. That makes sense. Protects the guidance from acquisition noise.
Exactly. They're managing expectations around that future deal flow uncertainty.
And what about the top line, the total revenue forecast? Did that get a boost too?
It did, yeah. The new forecast for total net revenues is now around $60.9 billion. That's up about $400 million from what they were guiding previously.
Okay, a $400 million increase. Now, this is interesting for listeners, I think. Where did that $400 million upgrade actually come from? Breaking it down tells you a lot about what's working well and maybe what's not working quite as well.
Right. You can really see the moving parts. So two areas drove big increases, $200 million each. First, Skyrizi global sales forecast went up by $200 million. That's driven by them gaining more market share in psoriasis and IBD, inflammatory bowel disease. That puts Skyrizi at $17.3 billion total now.
Okay, $200 million from Skyrizi. What's the other $200 million driver?
Neuroscience. Global revenues there also got bumped up by $200 million. That reflects strength in products like Vraylar, which they often call VLV, and also their newer migraine treatments, the oral CGRP portfolio. So neuroscience is now looking like a $10.7 billion business for the year.
Wow. So Skyrizi and neuroscience are carrying the load, adding $400 million between them, but the total increase was only $400 million. So something must have offset that a bit. Was there a soft spot?
There was, yeah. Aesthetics. That's things like Botox Cosmetic. Total sales forecast for aesthetics actually decreased by $200 million. The new total is $4.9 billion. And the CFO directly attributed this to greater than expected global market softness.
Market softness. So that sounds like a broader economic issue, maybe less discretionary spending.
Seems like it. It signals that maybe consumers are pulling back a bit on those kinds of treatments globally. So you had that $200 million decrease in aesthetics. The remaining $200 million of the overall $400 million net increase came from sort of the collective momentum of Rinvoq and some other products. It's a very clear picture. Strength in their core specialty areas is more than making up for some macro headwinds in aesthetics.
That trade-off makes sense. So connecting this back to the bigger picture, did the CFO reaffirm the main spending plans for the year, the P&L assumptions?
Yes, absolutely. And this really speaks to the stability and their commitment to investment. He reaffirmed several key full-year 2025 expectations.
Okay, like what are those big investment numbers looking like?
Well, adjusted R&D expense is still confirmed at $9 billion. That's a huge commitment to research. And adjusted SG&A expense, selling, general, administrative costs, that's confirmed at $13.5 billion. And despite all that spending, they're still anticipating an adjusted operating margin ratio of around 41% of sales for the full year.
41% margin while spending, what is that, almost $23 billion combined on R&D and SG&A. That's quite something.
It really is. It shows massive scale, cost control, and huge investment happening all at once.
So if that's the full year, what about the immediate next quarter, Q4? What are the projections there?
For Q4, they expect net revenues to be more than $16.3 billion. That number does get a small lift, about 1% from favorable foreign exchange rates, by the way. And adjusted EPS for Q4 is projected between $3.32 and $3.36. And again, the same caveat applies that EPS range excludes any potential acquired IPR&D costs that might pop up in Q4.
Okay, got it. Consistent messaging there. Now let's shift to how all this strong performance actually fuels their strategy, capital allocation. How does this translate into financial flexibility and shareholder value? How much cash are they actually working with?
Well, their cash balance at the end of September was over $5.6 billion. But maybe more impressively, look at the free cash flow. In just the first 9 months of the year, they generated about $13 billion in free cash flow.
$13 billion, that's huge.
It is. And interestingly, that figure already includes them paying out nearly $2.2 billion just from Skyrizi royalty payments they owe. So even after significant payments like that, the cash is just pouring in. It gives them enormous flexibility.
And with that kind of cash flow, they can really push on multiple fronts, right? Returning cash to shareholders and investing for growth. Let's start with the shareholder return piece, the dividend.
Definitely a priority. They announced a pretty healthy 5.5% increase to the quarterly cash dividend. That raises it to $1.73 per share, and that increase starts with the payout in February 2026. It signals real confidence for management that they can keep generating this level of cash flow consistently.
A 5.5% dividend hike is solid, but clearly that cash isn't just going to dividends. You mentioned the IPR&D earlier. They're obviously investing heavily. What did the CFO say about the pace of their deal making, business development or BD?
Oh, the pace is, relentless is probably the right word. Get this. Since the beginning of 2024, so less than 2 years, they've executed approximately 30 deals.
30 deals. Wow.
30 deals. Constantly looking for external innovation, buying new science, new assets across all their key growth areas. That cash flow isn't sitting idle. It's being actively deployed to build out the next generation pipeline.
Okay, so you've got a 5.5% dividend boost happening and this incredibly aggressive deal-making pace with 30 deals. Is this stretching them too thin? Is it impacting their balance sheet stability? Did the CFO address that?
He did. He made sure to reassure the market on that point. Despite all this investment activity, they are sticking to their core leverage goal. They reaffirmed they're still on track to hit a net leverage ratio of 2 times by the end of 2026.
2 times net leverage by end of 26. Okay.
Right. So the message is, yes, we're investing aggressively, but we can handle it financially, manage the debt, and hit our targets. They're confident they can balance it all.
Okay, let's step back then. If we were to summarize the main takeaway from just these CFO opening remarks, what's the picture it paints?
I think it paints a picture of really outstanding execution, fundamentally. You see the operational strength, particularly in those key growth areas, Skyrizi, Rinvoq, neuroscience. That's generating huge amounts of cash. And that strength is successfully covering for, unexpected weaker spots, like the macro softness we saw in aesthetics.
Right. And the strategic story seems really clear, too.
Exactly.
Yeah.
Use today's high performance and cash flow to lock down long-term growth. Pour resources into internal R&D, yes, but also aggressively pursue external innovation. I mean, taking that $1.50 EPS hit for IPR&D up front, combined with making 30 deals, it shows management is really prioritizing building a durable, diversified future pipeline, maybe even over just optimizing the current quarter's GAAP earnings.
It really is a fascinating balance of managing the present while aggressively building the future. Which brings us to a final thought for you, our listener, to maybe chew on.
Mm-hmm.
Given they just announced that solid 5.5% dividend increase, does the sheer volume of the business development, those 30 deals since early 2024, signal maybe a subtle shift? Are they prioritizing funding that future pipeline even more than immediate shareholder returns now? Or is the company just supremely confident that with this level of cash flow, they can absolutely master both sides of that equation, big returns now and big investments for later?
A great question. Are they juggling perfectly, or is one side getting slightly more weight?
Something to think about. We'll leave it there for this deep dive.